Hey everyone, James Smith here, and welcome to our deep dive today. We're going to be taking a look at Morgan Housel's The Psychology of Money. It's really a fascinating read, and I'm excited to have our expert with us to unpack it all.
Hi there.
So, we often think about being good with money is about, complex formulas or having some sort of insider knowledge.
Yeah.
But Housel really turns that idea on its head.
Yeah, that's right. He argues that understanding how we behave around money is actually much more important than, any technical know-how. It's those hidden emotions and biases, even the stories we tell ourselves about money, that really shape our financial lives.
One of the things that really struck me about this book was the way Housel uses storytelling to illustrate his points. He doesn't just throw out, dry economic theories. He brings these ideas to life with these captivating anecdotes.
Absolutely. I love the story about the tech executive who would flash around stacks of $100 bills. Like on the surface, he seemed incredibly wealthy, but his behavior really revealed a deep insecurity and a fundamental misunderstanding of how to manage money.
It's a perfect example of how financial success isn't just about how much you have, but about your mindset and your relationship with money.
Right. And that's where our personal histories come into play. Housel argues that our upbringing and experiences create a unique money lens through which we view the world.
To put it simply, your past experiences with things like inflation or recessions or even market booms shape how you see and interact with money today.
Yeah, and what's interesting is that Housel doesn't just say this. He gives specific examples to really illustrate his point.
Yeah.
He talks about how John F. Kennedy, coming from a wealthy family, lacked firsthand experience with the hardships of the Great Depression, and how that actually became a point of contention during his presidential campaign.
It's amazing to think how events that happened decades ago can still influence financial decisions today, isn't it?
It really is. He also uses the example of Bill Gross, known as the bond king. His father's generation, having lived through periods of high inflation, were very wary of bonds. Bill, on the other hand, had a much more positive view of bonds shaped by his own personal experiences.
So you're saying that we all have these money scripts, these ingrained beliefs about money that we've picked up along the way, often without even realizing it.
Exactly.
And these scripts can really influence our decisions without us even realizing it.
Exactly. And that leads us to the lottery paradox. Hazel uses this concept to show how our emotions and personal narratives can drive us to make decisions that might seem irrational to someone else.
This is where it gets interesting for you.
Yeah.
Think about this. Why do so many low-income households spend a significant portion of their income on lottery tickets? Logically, it doesn't make financial sense.
Right?
But to those buying the tickets, it makes perfect sense within their own narrative.
They're buying into a dream, a hope of a life-changing event. The emotional pull of that story, even if the odds are astronomically against them, is powerful. It's a great example of how our personal narratives can often outweigh cold, hard logic.
Which brings us to another key theme in the book, the role of luck and risk. Housel challenges this idea that financial success is solely about hard work and skill. Instead, he argues that luck and risk often play a much bigger role than we care to admit.
This is a bit of a tough pill to swallow, right? We love to attribute success to our own abilities, but Housel argues that often it's about being in the right place at the right time. It's about those chance encounters and unforeseen circumstances that can propel us forward or hold us back.
His example of Bill Gates really drives this point home. Gates had access to a computer terminal in high school in the late 1960s. I mean, how many teenagers had that kind of opportunity back then?
Not many.
And that single stroke of luck, combined with his talent and hard work, of course, played a huge role in his incredible success. On the other hand, Housel talks about Gates's equally brilliant friend, Kent Evans, who tragically died young in a climbing accident.
That story really struck me. It's a stark reminder that sometimes no amount of talent or hard work can overcome those unforeseen circumstances. It makes you realize that judging success solely on outcomes can be very misleading.
Exactly. We often focus on the winners and ignore the stories of those who, despite their talent and effort, didn't achieve the same level of success, perhaps due to factors entirely outside their control.
Yeah. Housel also discusses the contrasting outcomes of Jesse Livermore and Abraham Jermansky during the 1929 crash. Livermore initially, through sheer luck, amassed a fortune, while Jermansky, likely a skilled investor, lost heavily. It highlights how random events can impact even the most seasoned investors.
What's fascinating is that Livermore, despite his early success, eventually lost everything as well. It shows that even those who seem to have mastered the market can be vulnerable to risk.
And then there's the story of Rajat Gupta, a successful businessman who threw it all away for short-term gains from insider trading. a stark reminder that even brilliant minds can succumb to the temptation of quick riches, jeopardizing long-term success.
These stories really challenge us to reconsider how we view both success and failure, don't they? They make you realize that there's often a lot more to the story than what meets the eye,
Absolutely. They remind us that humility and understanding the role of chance are crucial when navigating the world of finance.
which I think leads perfectly into one of the core messages of the book, the power of time and compounding.
This is where Housel dives into the concept of patience and long-term thinking, right?
Exactly. He emphasizes that time, coupled with the power of compounding, is the most potent force in building wealth, arguably even more powerful than exceptional skill. He uses Warren Buffett, considered by many to be the most successful investor of all time, as a prime example.
And what's fascinating is that Buffett's success is less about making brilliant investment choices and more about his consistency and patience. He's been in the game for over 70 years, and that's where the real magic lies.
Housel highlights that most of Buffett's wealth was accumulated after he turned 50. That's the beauty of compounding. It's a slow and steady process that rewards consistency and patience, but given enough time, it can produce extraordinary results.
He contrasts this with someone like Jim Simons, who, while achieving incredible annual returns, has a much shorter track record. Even with exceptional skill, the potential of compounding is significantly limited without that crucial element of time.
So the takeaway here is that you don't have to be a financial genius to build wealth. It's more about consistently saving and investing over long periods and letting the power of compounding work its magic.
Exactly. It's a message that I think a lot of people need to hear, especially in today's world where we're constantly bombarded with promises of quick riches and get-rich-quick schemes.
Housel also stresses the importance of savings as the foundation of financial security. He argues that saving isn't just about hoarding money. It's about creating a buffer, a sense of control and freedom that allows you to make choices aligned with your values.
I love how he compares savings to energy conservation. Just like being more efficient with energy gives you more control, so too does having a solid savings cushion. You're less reliant on external factors like market swings and more in charge of your own financial destiny.
It's a great analogy, isn't it? It takes the focus away from chasing returns and puts it back on something we can actually control, our own spending habits.
Which brings us to another incredibly impactful message from the book: the value of controlling your time. Housel believes that money's greatest value lies in its ability to give you more freedom and autonomy to ultimately allow you to live a richer and more fulfilling life.
What stands out to you about this idea? I mean, it resonates with me personally. I remember when I interned at an investment bank, the pay was fantastic, but the long hours and constant demands were soul-crushing.
It was a valuable lesson for me. It made me realize that money on its own doesn't equal happiness or fulfillment. If you don't have control over your own time, if you're constantly sacrificing your well-being for a paycheck, then what's the point?
It's a trade-off that many people face. And Housel even points out that despite rising wealth in America, overall happiness levels haven't increased significantly. He suggests that this disconnect might stem from our increasing focus on material possessions, often at the expense of our time and freedom.
So we might be getting wealthier, but are we actually getting happier? That's a really thought-provoking question, and one that I think a lot of us could benefit from pondering.
It makes you wonder, are we playing the right game? Are we chasing the things that truly matter? Or are we stuck on a treadmill accumulating more and more stuff while sacrificing the things that bring true joy and fulfillment?
Housel then challenges us to consider the idea of embracing reasonable over rational choices when it comes to money. What he means is that sometimes the mathematically optimal strategy isn't always the best option in the real world, especially when factoring in our emotional well-being.
Can you give an example of what he means by this? Because on the surface, it seems a little counterintuitive.
He uses the analogy of suppressing a fever. While a fever is uncomfortable, it can actually be beneficial in fighting off an infection. In the same way, sometimes seemingly irrational financial choices can actually be beneficial in the long run, even if they don't make perfect sense on paper.
So it's about finding that sweet spot between what's optimal on paper and what we can realistically handle emotionally.
Exactly. And Housel goes even further, suggesting that we should even love our investments. The idea is that when you're passionate about what you're putting your money into, you're more likely to stick with it through the ups and downs to ride out those inevitable market fluctuations.
It's like any relationship, right? If you're constantly questioning and second guessing, it's not going to last.
But if you have a strong foundation of trust and belief, you're more likely to weather the storms together.
It's a great way to think about it. It takes the fear and anxiety out of investing and replaces it with a sense of purpose and excitement, which I think nicely transitions us into the next big theme, the power of narratives.
Housel talks about how economic narratives, often driven by negativity and pessimism, can significantly impact financial decisions, right?
He does, and he uses the 2009 recession as a prime example. Even though there wasn't a fundamental change in America's capacity to generate wealth, a shift in narrative, a story about collapsing housing prices and a failing financial system led to widespread panic and a devastating economic downturn.
That's a really scary thought. It highlights just how powerful stories can be, how they can shape our perceptions and influence our actions, even when those stories are based on fear rather than facts.
So how do we as individuals protect ourselves from falling prey to these potentially harmful narratives?
Housel doesn't offer a foolproof solution, but he stresses the importance of being aware of the narratives we're exposed to and critically evaluating their validity. He encourages us to question the stories we hear, to look beyond the headlines, and to form our own informed opinions.
It's about being critical thinkers, about not just blindly accepting what we're told, and instead seeking out multiple perspectives and forming our own conclusions.
Now, I think it's time for us to pause here for a moment and really distill some key takeaways from what we've covered so far. What are some of the most impactful insights you've gleaned from the psychology of money so far?
For me, it's the realization that saving is more about psychology than it is about math. It's about creating a sense of security and freedom that allows us to make choices aligned with our values.
It's interesting you say that because for me, Housel's emphasis on compounding was a real eye-opener. It's not about getting rich quickly. It's about consistently saving and investing over long periods and letting those small gains snowball into something remarkable over time, which actually requires a lot of patience and discipline, wouldn't you say?
Absolutely.
And something else that really stood out to me was his emphasis on embracing room for error. Life is unpredictable, and no financial plan can account for every possible scenario. Having a buffer, whether that's extra savings or a diversified portfolio, can help us navigate those unexpected challenges without derailing our long-term goals.
It's like having a safety net, a cushion to fall back on when things get tough. And I think his message about controlling your ego is also incredibly important. It's so easy to get caught up in the comparison game, to feel pressure to keep up with the Joneses. But true wealth is about defining your own version of success and making financial choices that support that vision, not someone else's.
So it's not just about accumulating wealth. It's about using it to create a life that feels meaningful and fulfilling on your own terms. A life where you have the freedom to pursue your passions, to spend time with loved ones, and to make a positive impact on the world.
Now, before we move on, I want to ask you what resonated most with you from what we've discussed so far.
I think what really hit home for me was Housel's emphasis on the importance of understanding our own money scripts, those often unconscious beliefs about money that we've developed over time. These scripts can have a huge impact on our financial decisions, so it's crucial to be aware of them and to question whether they're truly serving us.
What about you?
For me, it was the reminder that financial success isn't a straight line. There will be ups and downs, unexpected challenges, and even failures along the way. But it's about having the resilience to keep going, to learn from our mistakes, and to stay focused on the long-term vision.
I think that's a great point to end this part of our deep dive on. We've covered a lot of ground, but there's still so much more to explore. We'll be back soon to delve deeper into the fascinating world of the psychology of money. Until then, keep those money scripts in mind. Ask yourself, what stories are you telling yourself about money? How are those stories shaping your financial decisions?
And we're ready to uncover even more fascinating insights from this book.
You know, one of the things that really stood out to me in this section was Housel's concept of invisible wealth. He argues that true wealth is often hidden, not something you necessarily flaunt or show off. It's about having financial security and the freedom to make choices that align with your values.
He uses the analogy of a fancy car. You might see someone driving a Lamborghini and assume they're incredibly wealthy, but you have no idea how much debt they might be carrying, or if they're even truly happy.
Right. It's like that saying, more money, more problems. Appearances can be deceiving, and just because someone looks rich doesn't mean they're financially secure or even content with their lives.
Yeah, Housel emphasizes that real wealth is about what you don't spend. It's the freedom to take time off work, pursue a passion project, or simply have peace of mind knowing you have a financial cushion. That kind of wealth isn't always visible, but it's incredibly valuable.
So it's not about keeping up with the Joneses, but about creating a life that feels rich and fulfilling to you, regardless of what others might think.
Exactly.
And a big part of that is building a solid foundation of savings. Housel argues that savings are like a financial buffer protecting you from unexpected events and giving you the flexibility to pursue opportunities when they arise.
He even goes as far as to say that for many people, saving money is more effective than trying to outperform the market with their investments.
I can see how that might sound counterintuitive, but it makes sense when you think about it. Savings are entirely within our control. We don't have to rely on market fluctuations or hope for a lucky break. We simply choose to spend less than we earn.
It's a simple concept, but it's often overlooked in our consumer-driven society where we're constantly bombarded with messages to buy more, spend more, and accumulate more stuff.
And Housel also challenges the traditional view of retirement planning. He argues that trying to predict exactly how much money you'll need decades from now is almost impossible.
Yeah.
Our wants, needs, and goals are constantly evolving, so that fixed number we often aim for might not actually reflect what we truly desire in the future.
It's so true. When I was younger, I thought retirement meant sitting on a beach all day, but now I realize it's more about having the freedom to pursue whatever interests me at that point in my life.
Hmm.
Maybe it's traveling, starting a business, or simply spending more time with loved ones. Who knows what the future holds?
Exactly. It's not an endpoint, but a new beginning, a chance to explore new possibilities.
And that emphasizes the importance of aligning your financial decisions with your evolving values. What brings you joy and fulfillment today might be completely different in 10, 20, or 30 years. So how do we plan for that uncertainty? How do we make sure our financial decisions support the life we want to live both now and in the future?
That's a big question, and I think Housel would say that part of the answer lies in recognizing and addressing our sunk costs, those past investments of time, money, or emotion that can keep us clinging to paths that no longer serve us. It's a concept that applies to so many areas of life, not just finances.
Yeah, it's like staying in a bad relationship just because you've already invested so much time and energy into it, or refusing to sell a losing investment because you're emotionally attached to it.
We've all been there.
Hmm.
It's hard to admit we were wrong or that our circumstances have changed. But Housel argues that being able to adapt and adjust your course is essential for long-term success in finances and in life. Don't be afraid to cut your losses or change your plans if something isn't working.
And he suggests that having a barbell personality can be beneficial when it comes to managing money and navigating uncertainty.
A barbell personality, what does that even mean?
He's referring to the idea of being both optimistic about the future and paranoid about what could go wrong. It's about balancing a sense of possibility with a healthy dose of caution.
I like that. It's like walking a tightrope. You need to believe you can make it across, but you also need to be aware of the risks and take precautions to avoid falling.
That's a great way to put it. It's not about being reckless or overly cautious. It's about finding that balance between taking calculated risks and protecting yourself from potential downsides.
And this leads us back to the idea of embracing reasonable over rational decisions, which we touched upon earlier.
Right. Sometimes the most mathematically optimal strategy isn't the best choice in the real world, especially when it comes to our emotional well-being.
Housel reminds us that money is ultimately a tool to help us live better lives, not a source of stress and anxiety. Remember the study he cited about leveraged investing. The numbers show it can lead to higher returns, but the potential for volatility and large losses can be incredibly stressful. And for most people, simply not worth the emotional turmoil.
So it's about finding that balance between what makes sense on paper and what you can actually live with emotionally. It's about making choices that support both your financial and your mental well-being.
And he goes so far as to say you should love your investments. When you're genuinely passionate about what you're investing in, you're more likely to stay committed for the long haul, even when times get tough.
I love that analogy. It's like any relationship. If you're constantly second guessing and doubting, it's not going to be a healthy or successful partnership. But if you believe in the vision and trust the process, you're more likely to weather the storms and come out stronger on the other side.
And speaking of weathering storms, Housel spends a good portion of the book discussing the importance of understanding our own personal narratives about money. The stories we tell ourselves, often based on our past experiences and the messages we've received about money, can have a profound impact on our financial decisions.
He gives the example of the 2009 recession, which was largely fueled by a shift in narrative. The prevailing story about the stability of housing prices and the infallibility of the financial system suddenly crumbled, leading to widespread panic and a self-fulfilling prophecy.
It's a reminder that our perceptions and beliefs can be just as impactful as the actual numbers. We need to be aware of the narratives we're exposed to and critically evaluate their validity, especially in today's world where we're constantly bombarded with information, misinformation, and conflating opinions.
And this leads us to another important point, the role of luck and risk, which we touched on earlier. We often attribute success to skill and hard work, but sometimes it really boils down to being in the right place at the right time.
Also uses the example of Bill Gates, again, specifically his access to a computer terminal in high school. How many kids in the late 60s had that kind of opportunity? It was a stroke of luck that undoubtedly played a role in his incredible success.
And on the flip side, he talks about Gates's friend Kent Evans, who was equally brilliant but died young in a climbing accident. It's a heartbreaking reminder that sometimes no amount of skill or effort can overcome unforeseen circumstances.
It's a humbling thought, isn't it? We like to believe we're in control, but life can be unpredictable. And that's why Housel stresses the importance of having room for error in our financial plans. Unexpected events happen, markets fluctuate, and our circumstances can change in an instant.
Having a buffer, whether it's extra savings or a diversified portfolio, can help us navigate those challenges without derailing our long-term goals. It's like having a safety net. You might not always need it, but it's reassuring to know it's there.
And allows you to take calculated risks without fear of complete financial ruin. It frees you up to pursue opportunities that might otherwise seem too risky.
And this brings us to another key theme, the importance of controlling your ego, which can be a major obstacle to financial success. Ego can lead to overspending, reckless investing, and a constant need for external validation.
Housel argues that people with enduring financial success often have a propensity to not give a damn what others think about them. They define their own version of success and make financial choices that support that vision, not someone else's.
It's about freeing yourself from the pressure of keeping up with the Joneses and focusing on what truly matters to you. It's about choosing experiences over possessions, saving for the future, instead of indulging in instant gratification and simply saying no to things that don't align with your values.
It's about being intentional with your money and your life. It's about using money as a tool to create a life that feels authentic and fulfilling.
And that leads to another powerful idea that Housel explores the value of controlling your time.
He argues that money's greatest intrinsic value is its ability to give you more control over how you spend your time. It's about buying freedom and autonomy, which can ultimately lead to a greater sense of happiness and fulfillment.
He tells the story of a tech entrepreneur who realized that true wealth wasn't about the money he had in the bank, but about the freedom he had to walk away from a job he hated.
That story really resonates with me.
hmm
I remember when I had a summer internship at an investment bank. The pay was fantastic, but the long hours and constant demands left me feeling completely drained and unhappy. It made me realize that money isn't everything if you don't have control over your own time.
It's a trade-off many people face, especially in today's fast-paced world. Housel even points out that despite rising wealth in America, happiness levels haven't increased significantly. He attributes this to our focus on material possessions, often at the expense of our time and freedom.
It's a sobering thought, isn't it? We work so hard to acquire things, but often those things end up owning us. We become slaves to our possessions, our debt, and our never-ending desire for more.
It's a trap that's easy to fall into, but Housel offers a way out. He argues that true wealth is about aligning your financial decisions with what truly matters to you. It's about using your money to buy back your time, your freedom, and your peace of mind.
So it's not just about accumulating wealth. It's about using it to create a life that feels rich and meaningful on your own terms. It's about designing a life where you have the time and resources to pursue your passions, to spend time with loved ones, to make a difference in the world, and to simply enjoy the journey.
And sometimes that means making choices that seem counterintuitive or even irrational to others. It means resisting the temptation to keep up with the Joneses and instead focusing on building a life that feels authentic and aligned with your values.
Housel talks about how our personal experiences, especially those we have early in life, can shape our views on money and investing. He uses the example of people who lived through the Great Depression. They often developed a deep aversion to debt and a strong preference for saving, even when those behaviors weren't necessarily the most financially advantageous in every situation.
It's a classic example of how our money scripts, those unconscious beliefs about money that we've developed over time, can influence our choices, even if those choices don't always align with our current goals or circumstances.
It's fascinating how something that happened decades ago can still have such a powerful impact on our financial decisions today.
It really highlights the importance of being aware of those money scripts and understanding how they might be influencing us. It's about questioning those ingrained beliefs and being willing to challenge the status quo, even if it feels uncomfortable.
Housel also talks about the danger of extrapolating present trends. We often assume that what's happening now will continue to happen in the future, but history shows that things rarely move in a straight line.
He uses the example of oil prices in the early 2000s. Many experts predicted that we were running out of oil and that prices would continue to skyrocket, but then fracking technology came along and the whole narrative shifted.
It's a reminder that the future is inherently unpredictable. We need to be prepared for the unexpected and avoid making decisions based solely on what's happening in the present moment.
It's like trying to drive a car while only looking in the rearview mirror. You might be able to stay on the road for a while, but eventually you're going to crash.
You need to look ahead, be adaptable, and be willing to adjust your course as needed. And that leads to another important concept, the importance of having a margin of safety in our financial plans.
Housel argues that we should always plan for things to go wrong, even if we don't know exactly what might go wrong. It's about building a buffer, whether it's extra savings, a diversified portfolio, or simply a flexible mindset to help us weather those inevitable storms.
It's like building a bridge that can withstand a heavier load than you expected to carry, or having extra savings to cover unexpected expenses. It's about creating a cushion between what you think will happen and what could happen.
That cushion can give you a sense of security and freedom that allows you to take calculated risks without fear of complete financial ruin.
Which brings us back to the idea of controlling your ego. It's about recognizing that we don't need to be right all the time. It's okay to make mistakes, to change our minds, and to adapt our plans as we learn and grow.
It's about focusing on the long game, not getting caught up in short-term fluctuations or comparing ourselves to others. It's about defining our own version of success and making choices that support that vision.
It's about recognizing that money is simply a tool, a means to an end. The real goal is to use that tool to create a life that feels rich, meaningful, and fulfilling on our own terms.
And on that note, I think it's time to take another pause. We've explored so much in this section, and I'm curious what's resonating most with you right now.
For me, it's the reminder that true wealth isn't about the numbers in your bank account. It's about having the freedom and flexibility to design a life that feels authentic and aligned with your values. It's about having the time and resources to pursue your passions, to spend time with loved ones, to make a difference in the world, and to simply enjoy the journey.
What about you? What's standing out for you right now?
I think for me, it's the emphasis on controlling our narratives. We're bombarded with so many messages about money success and what it means to live a good life. It's easy to get caught up in those external narratives and lose sight of what truly matters to us as individuals.
So the challenge is to become aware of those narratives, to question their validity, and to consciously choose the stories we want to shape our lives.
I think that's a powerful message to carry with us as we move into the final part of our deep dive.
We'll be back soon to explore even more Housel's insights and discuss how we can apply these principles to our own financial lives.
Until then, think about those narratives. Are they empowering you? Are they leading you toward the life you want to create?
It's been quite a journey, hasn't it? Housel has given us so much to consider when it comes to our own financial decisions and the often hidden forces that shape them.
In this final part, I thought we could bring some of these ideas to life by diving into some specific stories from the book. They really highlight the practical side of Housel's message. What do you think?
Yeah,
I think that's a great idea. Sometimes it's those real-life examples that make the concepts click.
Absolutely. One that really stuck with me was the story of Heinz Berggruen, the art dealer.
Yeah.
Um, he amassed an incredible art collection, not by trying to pick out, individual masterpieces, but by buying entire portfolios of art.
That's an interesting approach. I mean, wouldn't you want to be more selective? Especially with something like art.
You'd think so, right? But Berggruen understood that he couldn't predict with certainty which pieces would become valuable over time. So he spread his bets knowing that most of what he bought wouldn't appreciate significantly, but a few key pieces would.
And that strategy, embracing the unknown and diversifying his bets, led to a collection worth hundreds of millions of dollars. It's a brilliant example of how you don't have to be right all the time to succeed.
It reminds me of that concept. Housel talks about tails driving everything. He argues that it's often a small percentage of investments, businesses, or even life events that account for the majority of the outcomes. It's those outliers, those unexpected wins that can really make all the difference.
He uses the example of venture capital, where the vast majority of startups fail. But a handful of massive winners can generate outsized returns for the entire industry.
And he points out that this pattern isn't limited to startups. Even in the stock market, a small percentage of companies often drive the majority of the gains.
So it's not about trying to predict the future perfectly or picking the single winning stock. It's about understanding that a few big wins can outweigh many small losses. It's about playing the long game.
Which brings us to another story that I found really inspiring, Walt Disney's early struggles. Before the iconic empire we know today, Disney faced numerous setbacks. His first studio went bankrupt, and many of his projects were considered risky and expensive flops.
It's hard to imagine Disney, of all people, facing financial challenges. It's a reminder that even the most successful people often encounter failure along the way.
Exactly. And Housel's point isn't that we should try to avoid failure altogether, but rather that we should have a plan for it. We need to build in enough room for error to allow ourselves to keep experimenting, keep learning, and keep pursuing our goals even when things don't go as planned. What do you think? Does that resonate with your experience at all?
Absolutely. I think about some of the projects I've been involved with. The ones that were truly successful weren't always the ones that went perfectly smoothly from the start. They were the ones where we had the flexibility to adapt, to learn from our mistakes, and to pivot when necessary.
Housel encourages us to focus on the overall performance of our portfolio, not just our individual wins or losses, whether that's a financial portfolio or our portfolio of experiences in life.
That's such a valuable perspective, isn't it? It's easy to get caught up in the day-to-day fluctuations, to celebrate every small win and despair over every setback. But it's the long-term trend that really matters.
It's about focusing on the big picture and trusting the process.
Howells also shares a personal story about a friend who achieved his lifelong dream of becoming a doctor, but then found himself profoundly unhappy with his career choice. He'd invested so much time, energy, and money into achieving this goal only to realize it wasn't what he truly wanted.
It's a powerful example of how our goals and desires can change over time. We can work tirelessly towards something, only to realize that it doesn't bring us the fulfillment we expected.
It highlights the importance of being flexible, adaptable, and willing to adjust our course as our values and priorities evolve. Sometimes that means letting go of something we've invested heavily in, which can be incredibly difficult.
Housel cautions against getting caught up in sunk costs.
Yeah.
Those past investments, whether time, money, or emotion, that can keep us clinging to a path that no longer serves us. He even quotes someone who said, "I have no sunk costs." What a freeing philosophy. It's about recognizing that the past is the past, and we're not obligated to keep repeating patterns that are no longer beneficial.
It's about giving ourselves permission to change our minds, to try new things, and to create a life that truly reflects who we are today, not who we were yesterday.
Now, before we wrap up this deep dive, I want to share one final thought that really resonated with me throughout the psychology of money. It's the idea that there's no single right way to manage money. There's no magic formula or guaranteed path to success. What works for one person might be disastrous for another.
You know, that's something we've touched on throughout this conversation, haven't we? The importance of individual circumstances, personal values, and risk tolerance. It's not a one-size-fits-all approach.
Exactly. And Housel encourages us to define our own game, to focus on what matters most to us and our families, and to make choices that align with those values, regardless of what others might be doing or what conventional wisdom might dictate.
It's about finding what feels right for you, both financially and emotionally. It's about creating a financial life that supports your overall well-being and helps you create a life that feels truly rich and meaningful.
And I think that's a beautiful note to end on. Thank you for joining us on this deep dive into the psychology of money. I hope it sparked some reflection and inspired you to take a closer look at your own relationship with money.
It's been a pleasure exploring this book with you. And remember, this is just the beginning of your journey. Keep learning, keep growing, and keep striving to create a financial life that feels both prosperous and purposeful.